Welcome back to the Investing on the Go podcast brought to you by FundCalibre. Today, the 5th of April, 2022, starts World Sustainable Energy Days, a leading annual conference on the energy transition and climate neutrality with more than 650 participants from over 60 countries. In this episode, we discuss the energy transition with Will Argent, investment advisor to the VT Gravis Clean Energy Income Fund.
I'm Ryan Lightfoot-Amanoff, and today I'm joined by Will Argent, who is a fund advisor to the elite-rated VT Gravis Clean Energy Fund. Will, thank you very much for your time today.
Pleasure, thank you.
Now, the trend to renewable energy was gathering pace and has been for many years. But do you think that current macro issues with Russia and our dependence on its gas will accelerate this move further, or do you think there'll be a move towards sort of nuclear power? We've heard the Prime Minister considering this recently, so which way do you think it's going to go?
Ryan, I think it's probably going to be a bit of both, to be honest. Recent geopolitical events have brought Europe's dependence on gas, or Russian gas, into the spotlight, of course. And there is already a move to accelerate the build-out of renewable energy capacity across the region. I think in recent years, the conversation around renewables has understandably been around emissions reductions, objectives, and the green agenda. However, if you can install more localized renewable power generation, it does bring benefits in terms of security of energy supply. So I think this benefit is something that's likely to be talked about more going forward. But of course, harnessing the full potential of renewable energy generation, which of course is intermittent, is also a major consideration. In terms of nuclear, I think nuclear is going to form part of the global energy supply mix. You have different views, however, across different jurisdictions. Germany is a good example. Germany was expecting to phase out nuclear this year. And it may now extend the life of some of its nuclear assets. But, I don't think they haven't suggested that they'll reverse the general move to phase out nuclear. Meanwhile, as I think you mentioned, the UK government has been really keen, I think, to develop more smaller scale nuclear power plants around the country. And that was even before recent events.
And you mentioned the word intermittent in that answer and talk about renewables. When we do think of them, renewable energy, we think of wind and the sun, things that are largely dependent on the weather, which in the UK market, as we've seen this week, where I've currently got sunshine and snow in April, can be a little hit and miss. So what advances have been made in energy storage to make that supply more reliable?
Your observation is correct. Wind and solar, the most widely adopted and scalable forms of renewable power, are of course intermittent wherever you are in the world. They are dependent on wind resource and irradiation levels, but battery storage technologies have developed to a stage where large scale, utility scale battery assets are being introduced to the grid network. And what this means is that power generated from renewable sources can be stored when those generation levels are really high, and then to be stored and deployed when needed. So batteries will form an increasingly important role in harnessing the full potential of renewable energy capacity and just sort of smoothing out supply-demand imbalances over a particular period. I think it's also worth mentioning that hydroelectric power plants may also be used in the context of energy storage, perhaps not so much in the UK, but elsewhere geographically. I mean, when renewable power generation supply is really prevalent, excess power can be used to pump water upwards, essentially for release through the hydroelectric plant at a later point when required.
And now, obviously, energy prices have been hitting the headlines a lot recently, especially the last week with the increase in the cap. Do you think that renewables will be able to bring down the price of energy in the sort of the medium to longer term?
It's a good question. I think, if we take the UK as an example, the price of electricity is set by the marginal source of electricity generation. It's a merit order. That marginal supplier of generation tends to be gas. So the spike in gas prices recently is why electricity prices have risen. Now, over the longer term, more lower cost renewable power generation capacity, alongside sufficient storage capacity, could ultimately, squeeze out gas as the marginal source of generation more frequently, and thereby bring down the cost of electricity.
And how do these high energy prices affect the companies themselves and the things that you invest in? Many of the renewables have fixed price contracts, but are they based on energy futures? Perhaps you could explain this and how it works for the source companies that you look at.
Yeah, that's right. We invest in companies that own diversified portfolios of renewable power generation assets. Now, different companies will adopt different strategies in terms of hedging out their merchant power price exposure. Some will retain higher pricing risk and thereby stand to benefit more in the prevailing environment of higher prices. But if you consider a typical renewable energy company will own a large diversified portfolio of assets with power purchase agreement contracts for the output they produce. Those contracts expire on a sort of rolling basis across the portfolio. The more persistent recent higher prices are, the more likely these will be captured as contracts are renewed. Now, different jurisdictions have different power market characteristics. In the UK, companies may typically be able to hedge or fix their sort of power price exposure on a horizon of perhaps a few years. Elsewhere, such as in the US, companies can strike really very long-term power purchase agreements for the output they produce, extending to 15 or 20 years, quite commonplace, perhaps even 30 years in the case of some hydroelectric assets. There'll typically be some form of ratcheting mechanism in the contracted prices over those very long time frames, however, which gives a little bit of protection or uplifts to pricing over time. But I think what I'd also highlight is that although recent trends mean investors may want to own companies with more merchant price exposure, it was only very recently that power prices were very, very low indeed, the result of the economic hiatus brought about by the pandemic. So I think on a longer term view, the benefits of locking in price certainty should, certainly not be overlooked.
And one of the sort of big things that's coming into energy prices will be the move to electric vehicles. This is going to shift the dynamics for them becoming a bit more expensive now. Do you think that's going to hamper the adoption, or do you think that the higher oil prices and petrol prices are going to offset that? What are the dynamics of the higher energy price going to have on electric car adoption?
Yeah, I have to be honest. It's not a major area of focus for me in terms of our clean energy strategy. But I think what it's fair to say is, sales of EVs are growing rapidly. You only have to look at the data to see the sort of rapid growth in adoption, but also in terms of taking market share from conventional vehicles. That's certainly the case across Europe. I'm not so sure the recent increase in energy costs has a significant influence on that sort of rate of consumer adoption, or an influence on people's decision. Because, as you sort of mentioned, petrol prices have risen sharply as well, of course. Higher electricity prices are a function of higher fossil fuel prices, particularly gas, as we've touched upon. So I think it's not really going to have had a significant impact.
And one area that people perhaps sort of overlook when they're thinking about greenhouse gas emissions and things like that are buildings, which make up about 30% of total emissions. So what are the opportunities here in terms of adopting either renewable energies, we've already talked about, or becoming more energy efficient for existing buildings?
Yeah, it's a big area of focus. there are significant opportunities for improvements in energy efficiency to drive down greenhouse gas emissions and energy usage in general. This could be through the introduction of co-located renewable energy generation capabilities, on site, things like district heat networks, simply things like better insulation, more efficient lighting, and so on. I think regulations will help drive improvements in these regards over time. But I think it's also very interesting, to point out that actually when we look at the projections supplied by the sort of major energy consultancies in terms of the required investment to reach net zero ambitions, for example, energy efficiency investment actually forms a larger component, monetary component, compared to what's sort of required in terms of renewable energy supply capacity. A big sort of emerging opportunity set potentially.
Thank you. And now finally, just sort of turning to your portfolio a little bit, I see one of the biggest weights in terms of security types you've got in there is a thing called yieldco equities. Can you just explain to our listeners what they are, please?
Yeah, sure. It's a bit of a catch-all term. Yieldco is really a term commonly used in North America to describe companies that are created to own physical operational assets that produce predictable cash flows. These cash flows are underpinned by the long-term contractual arrangements we mentioned a moment ago. So yieldcos are prevalent in the energy sector. And of course, in our case, we focus on yieldcos that house portfolios of renewable energy infrastructure assets, such as wind farms and solar parks. Yieldcos will often have a sponsor, a major shareholder that will undertake perhaps the less predictable activities in terms of renewable energy capacity build out, so the development of new projects, for example. And there'll often be an arrangement in place between the yieldco and that major shareholder or sponsor, so that the yieldco gets optionality or first refusal on those assets once they've been energized and de-risked. Yieldcos are created to distribute a really high proportion of cash flow generation to investors in the form of dividends, and of course that clearly suits our income focused strategy in this area.
Brilliant. Well, Will, that's been really interesting. Thank you very much for your time today.
Thank you.
Renewable energy is undergoing mass adoption, a trend which this fund taps into directly. It aims to capture a blended portfolio of the best listed vehicles across the developed market and give an anchor to portfolios through defensiveness and steady income. To learn more about the VT Gravis Clean Energy Income Fund, visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.